Hello, welcome back to class. This is the last module of the costs and management accounting, and we'll be talking about the strategic management accounting and performance measurement. And under this, we will look at the role of management accounting in strategic planning. We'll look at the balanced scorecard approach. We'll also look at the key performance indicator, value-based management, and we'll also look at the sustainability and ethical consideration in cost management. When we talk about strategic management accounting, what do we mean? It actually expands traditional management accounting beyond cost analysis and budgeting. It combines both financial and non-financial information to help organizations make better long-term decisions. It focuses on achieving competitive advantage and creating value for stakeholders. Also, it helps managers link accounting data differently with the organization's goal and strategy. And lastly, modern strategic management accounting also emphasizes sustainability and ethical responsibility in the business decision. What are the roles of management accounting in strategic planning? The first one is that management accounting now serves as a key tool in strategic planning and decision making. Also, it provides accurate, timely information that guides managers in setting long-term goals. It also, through careful analysis, it also ensures that resources are used efficiently to achieve objectives. And management accountant helps to translate strategy into measurable actions and results. And they also monitor performance and provide feedback to ensure that plans stay on track. What are the major functions of management accounting and strategy? And these include management accountant provides relevant financial and operational data to support strategic decisions. They analyze competitors, market trends, and industry changes to help management stay competitive. They also prepare strategic budgets and evaluate investment options to ensure resources are well allocated. Also, they develop performance measures such as key performance indicators and balance scorecard to monitor progress. They identify and manage risk through techniques such as the sensitivity and scenario analysis. And lastly, they apply strategic cost management tools such as the activity-based costing, target costing, and life cycle costing. We have tools used in strategic planning. The first that we'll be talking briefly about is the SWOT analysis, and this is used to identify the strength, weakness, opportunity, and threat within and outside the organization. Another is the PESTEL analysis, and this helps to examine the external forces or factors such as the political, economic, social, technological, environmental, and legal influences. And for another tool is the balance scorecard, and for this it converts an organization's vision and strategy into measurable goals. We also have the value chain analysis, which identifies where value is created and where cost can be minimized. Also, for benchmarking, it allows a business to compare its performance with competitors or industry standard. For balance scorecard, the balance scorecard is developed by Kaplan and Norton, and it combines financial and non-financial measures of performance. It links everyday operation with the organization's long-term strategy, and this, unlike the traditional accounting system that focuses on only on financial results, the balance scorecard considers other critical areas of performance and it provides a more complete picture of how well an organization is achieving its strategic objective. Um, Lastly, the balance scorecard promotes balance between short-term financial successes and long-term growth. We have four perspectives of the balanced scorecard. The first one is the financial perspective, which deals with measures, which measures profitability, growth, and return on investment. It also answers the question, how do we look to our shareholders? Another is the customer perspective, which focus on customer satisfaction, the loyalty, and market share. We also see the it answer, how do customers see us? Another is the internal business process perspective, which examines the efficiency and quality of internal processes and answer the question, what must we do well to succeed? And lastly, on the perspective is learning and growth perspective, which emphasizes employees training, innovation, and technology improvement. And it answers the question, can we continue to improve and create value? The next is the key performance indicator. And for key performance indicator, they are measurable values that shows how effectively an organization is achieving its goals. KPI translates complex objective into clear, quantifiable metrics that guides performance, and an effective KPI must be smart. That is, it must be specific, measurable, achievable, relevant, and time-bound. Example of this include financial KPI, we have the operational KPI, we have the customer KPI, we have the employee KPI. And for the KPI helps managers to identify areas for improvement and aligns daily activities with strategic goal. We also have the last one on the list, which is the value-based management. And for value-based management, it is actually an approach that focuses on creating long-term value for shareholders and stakeholders, and it aligns the company's strategies, the decision and performance with the goal of increasing economic value. And it emphasizes that business success should be measured by value creation, not just by accounting profit. And the common value-based measure includes the economic value added. It talks about the profit after deducting the cost capital, and then the market value added, which is the difference between the company's market value and invested capital. And the last is the cash flow return on investment, which is the cash return compared to the capital investment. So VBM encourages accountability, innovation, and sustainable growth across all levels of the organization. We have the sustainability and ethics consideration in cost accounting, and this is managing costs in a way that protects the environment and supports society. And it involves practices such as reducing waste, improving energy efficiency, and using eco-friendly materials. Also, ethical cost management ensures fairness, honesty, and transparency in financial reporting and decision making. An accountant must not manipulate reports or exploit workers and suppliers to cut costs, and they should rather follow ethical principles such as integrity, objectivity, confidentiality, and professional competence. And sustainable and ethical cost management builds trust, reputation, and long-term success. In conclusion, management accounting has served as a bridge between strategy and performance, and it connects long-term plans with daily operations through the tools that we've discussed. It also ensures that decisions are made not only for profit, but also for ethical and sustainable growth. And this integration helps organizations achieve competitive advantage and maintain stakeholders' trust. Therefore, management accountants are key strategic partners in achieving business excellence. Thank you for walking through the class to the very end. Please do well to study more on it. Thank you.